Hey everyone, and welcome back to The Explainer. I am so pumped you're hanging out with us today. So, we're talking about the one time of year when most Americans feel genuinely pretty great about their finances. Tax refund season, right? A check arrives, sometimes for thousands of dollars, and it just feels like an absolute win. But what if I told you that treating this money like some kind of sudden windfall is exactly what's keeping you from building real wealth? Okay, let's dive right into this. Our whole goal with this explainer is to completely transform how you look at your tax refund. We're going to take it from being just a fleeting weekend splurge and turn it into serious, undeniable financial momentum.
But real quick, before we get into the weeds, just a brief heads up. Everything we're covering in this explainer is strictly for educational purposes. I'm here to break down the data and the math for you, but this isn't personalized tax or financial advice. Because, tax situations vary wildly from person to person. So please, definitely consult a licensed tax professional or CPA before you go altering your withholding or your tax strategy. Okay, with that out of the way, let's get into the numbers.
I want you to think about this number for a second. $3,276. As of early May, that is the average 2026 tax refund. It's actually up about 11.5% from last year, which is largely thanks to some new deductions baked into the One Big Beautiful Bill Act. But here's the absolute most crucial thing I need you to take away from this number. This money is not a gift from the government at all. It is literally your own money. It's money that was skimmed off every single one of your paychecks all year long and then held by the IRS completely interest-free until you finally ask for it back. You essentially gave the government an interest-free loan. To fix this whole cycle, here's our roadmap for today. First, we'll do a quick reality check. Then we'll cover refund mistakes 1 and 2, followed by mistakes 3 and 4. We'll talk about the massive danger of skipping your priorities, give you a ranked playbook, and finally show you exactly how to fix next year's withholding. So, let's kick things off with Section 1, the tax refund reality check. What's actually super fascinating about the data is that most people aren't out there blowing their refunds on lavish vacations or giant flat-screen TVs. Surveys show that taxpayers most commonly put their refunds toward basic monthly bills, groceries, and credit card debt. Now, on the surface, that sounds incredibly responsible, doesn't it? But we need to look a little closer. If your tax refund is going toward basic things like monthly bills and groceries, that means your standard monthly income simply isn't covering your monthly expenses. The refund is just a Band-Aid. It's plugging a structural gap in your budget. And the very moment that $3,276 is gone, boom, the gap reopens. You're coming up short again next month. The harsh reality is that using an annual windfall to cover a monthly shortfall doesn't fix your finances. It just delays your underlying budget crisis by exactly 12 months. Moving right along to Section 2, refund mistakes 1 and 2. Mistake number 1 is treating this check like it's just found money. This actually stems from a psychological trap called mental accounting. Basically, when money shows up as a lump sum rather than a normal expected paycheck, our brains categorize it totally differently. It feels like a bonus. We treat it with looser rules, and that leads directly to impulsive discretionary spending. But we really need to reframe this. Your tax refund is not new bonus money. It is deferred old income that you already earned between January and December of last year. It should be treated with the exact same respect you give your hard-earned paycheck, with a strict plan, not just blown on a weekend impulse. And this brilliantly leads us to mistake number 2, which is getting a large refund in the first place. Mathematically speaking, getting a $3,276 refund means you overpaid the IRS by about $273 every single month. The IRS paid you exactly 0% interest while your money just sat there collecting dust. Think about the opportunity cost. If you had kept that $273 a month and just tossed it into a high-yield savings account at 4% APY, you'd have earned about $71 in interest. But actually, it gets so much worse. What if you're carrying $3,276 in credit card debt? By putting that $273 a month toward a 21% APR credit card instead of handing it over to the IRS, you would have completely wiped out that debt in 12 months and saved roughly $687 in interest. Overpaying your taxes is literally costing you serious wealth. All right, let's jump into Section 3, refund mistakes 3 and 4. Mistake number 3 is a wild one, paying for refund advance loans. Tax prep companies will aggressively pitch you these rapid refund products so you can get your money just a few days early. But let's look at the actual numbers. If you take a $3,000 refund advance and pay a $150 fee just to get it 21 days earlier, you are effectively paying an annualized interest rate of roughly 87%. Let me repeat that. 87% interest on your own money, money the government already owes you. The better alternative? Just file electronically and use direct deposit.
9 times out of 10, e-filed returns hit your bank account within 21 days anyway. Never, ever pay a company to access your own already earned income.
Which perfectly brings us to mistake number 4, having absolutely no plan before the money actually arrives. Behavioral science tells us that decisions made in advance are dramatically better than the ones we make at the moment of receipt. It's a concept known as pre-commitment. Look, if the money hits your checking account on a Tuesday and you don't have a plan for it, I guarantee by Sunday it's going to be gone on things you definitely didn't need. You have to eliminate that impulse window. Before the refund even clears, log into your banking app and schedule a transfer. Automated. Move the money to your savings or investment account before you even have a chance to feel how good it is to have extra cash sitting there.
Next up, Section 4, Mistake 5, which is skipping priorities. Mistake number 5 is spending the refund before your actual financial priorities are met. The absolutely crucial point here is that there is a strict, sequential order you need to follow when you get a lump sum of cash. Step 1 is tackling high-interest debt over 15% APR. Paying off a 21% credit card gives you a guaranteed 21% return on your money. You can't beat that. Step 2 is an emergency fund minimum of $1,000. This acts as your circuit breaker to stop you from sliding into more debt when, say, a tire blows out. Step 3 is retirement contributions, like funding an IRA or 401k. Step 4 is aiming at specific financial goals, maybe saving a down payment for a house. And then finally, Step 5 is guilt-free discretionary spending. The ultimate mistake people make is skipping steps 1 through 4, jumping straight to Step 5, and then wondering why their financial situation never seems to improve year after year. Let's move on to Section 5, the Ranked Refund Playbook. Let's see how all of this builds into highly actionable solutions based on your specific financial reality. We've mapped out 3 distinct scenarios. Scenario A is for the viewer who is dealing with high-interest debt. If you receive that average $3,276 refund, your playbook looks exactly like this. You drop a massive $2,500 right onto your highest interest credit card balance. That guarantees you an incredible return on your money. Next, you put $500 into a starter emergency fund, so you aren't forced to reach for the plastic again next month. And notice this last part. You specifically carve out $276 for guilt-free spending. You handled your business, you made the smart moves, so you get to enjoy a piece of it without an ounce of financial anxiety. Now, Scenario B is for someone who is completely debt-free, but maybe lacks a solid savings buffer. Here, we allocate the largest slice, $2,000, straight into your emergency fund. This gets you working toward covering a full 3 months of living expenses. Then we jumpstart your wealth building by dropping $1,000 into a Roth IRA. And just like before, we keep that $276 for guilt-free spending. We include this step because a financial plan with absolutely zero room for enjoyment, yeah, that's a plan that leads straight to budgeting fatigue. Having that 10% of fun makes the other 90% totally sustainable. And finally, Scenario C. This is for the financially secure viewer. You have no bad debt and you already have a fully funded emergency savings account. In this case, we use the refund strictly for wealth building. $2,000 goes directly into a Roth IRA or a taxable investment account. Then $1,000 goes toward a specific earmarked life goal. Maybe it's a home down payment or a travel fund. And again, $276 is there for you to spend completely guilt-free. The real secret here is earmarking. Unearmarked savings just have a funny way of magically disappearing. Which brings us to our final stop, Section 6, Fixing Next Year's Withholding. Okay, now that we've intelligently allocated this year's money, let's fix the structural problem once and for all. We still have roughly 8 months of 2026 left to stop giving the IRS free money. Here are the exact mechanical steps you need to take literally today. First, go to irs.gov/W4 app. That's the official tax withholding estimator. Second, grab your most recent pay stub and last year's tax return. The tool is going to calculate if you are on track to get another massive refund and tell you exactly how to bring your withholding back into balance. Third, take that updated W-4 form and submit it directly to your HR department. By doing this, you instantly redirect that $273 back into your monthly paychecks. Directed intentionally, having an extra $273 a month compounding over 12 months does so much more heavy financial lifting than a lump sum you get and just spend in a single weekend. So, after going through all that, it brings us to the ultimate question for you. What did you actually do with your 2026 tax refund? Did it change your financial trajectory, or did it just sort of disappear without a trace? If you found this structure breakdown helpful, please make sure to hit that like button, share this with that one friend you know who always overpays the IRS, and subscribe to SenseWise for new explainers every Sunday, Tuesday, and Thursday. Also, drop a comment below and let us know your refund strategy. I'm going to leave you with this one thought. If your tax refund is the biggest check you see all year long, are you really managing your money, or is the IRS managing it for you? Stay smart out there, and I will see you on Sunday.